Hey everybody, Smart Silver Stacker here. Welcome to another live stream. We have got some interesting price action, as you can see here, in the price of silver. Looking at the monthly chart. Now, if you go back 1 month today, silver has actually gone up almost 11% in that time period. It's been a pretty big week for silver. We've got some very strong technical indicators for the metal. We've got some very strong fundamental cases for the price of silver. We're going to be getting into several of those today. Now, before we do that, I just want to look real quick here. Let's add gold to this chart. And you can see that now, over the past month, silver has actually outperformed gold. Gold up about 7% in that same time period. Silver up more than 10%. And I think this is a sign that we are beginning to really enter the ascending phase of this bull market. This is where we're going to start to see silver really move, and we're going to start to see that gold to silver ratio compress. Now, let's take a look at the broad market here, just at today's action before we get into some of the stories I have for all of you. So silver's up today. Just about everything else is down. I mean, even gold basically flat on the day, but silver putting on a pretty good gain, up over 1%. Markets in the red, all the broad indexes except for the Russell 2000 in the red. Crude oil basically flat, still up, still elevated, and we'll talk about that as well, why that's likely to go much higher. Bitcoin today taking a bit of a haircut, so silver's really holding its own. And again, this is a sign that now the time for silver is here. It is arriving. We're going to start seeing some very big days. Now, of course, nobody can predict the future. Nobody knows for sure. But we're going to make the case in today's video that the odds are stacked in favor of those of us who are taking a long position in silver at today's prices. The gold to silver ratio here, courtesy of today's video sponsor, Bullion. You can see now it's down to just over 85. This was at 90 just last week, or a few trading sessions ago. You can see if I pull up a longer term chart here, back on February 28th, so about 2 weeks ago. The gold to silver ratio was topping over 90, and I pointed out at that time that, elevated gold to silver ratio like that was a screaming buy signal, and well, silver's done pretty well since then. And it's not done yet. I mean, 85 is still very high. If we zoom this chart out to its maximum, you can see that in the bull run in 2011, this ratio got down as low as 32, and yet a high point in this, ratio, when you get down to, or you get up to like 70 here, 76 back in 2008 when the metals were crashing, that was a great entry point. Well, I think we're at a similar point right now, and silver is going to be taking off, but, it's still very cheap right now. Even though we had a good month this past month, it's just the beginning of what is coming. Silver bullion at Bullion still very affordable. You can get it for over 89 cents over spot. If you get 1 ounce bars or kilo bars, junk silver's $1.99. I think these are some of the most undervalued assets on the planet right now. Also, low premiums indicate that the public is not really moving into this market in a big way, and yet that is about to change. We're going to examine some stories that indicate why. First, let's start off with this from X, formerly known as Twitter, from this guy, David. I don't know, he must post some good silver stuff as I follow him, but he's got an interesting chart here. Now, we've been talking about the cup and handle formation in silver, but also you have this triangle forming, which silver, now he says silver has broken out. I'm going to go ahead and say it's a little premature to be celebrating that just yet. In fact, out of this pattern, you can see that silver had a kind of another breakout similar to what he's pointing at here. And yet still, from a technical standpoint, if we got to close a little bit higher, maybe around 26 bucks, it does look like we are breaking out of this pattern in a big way, and it's probably going to move much higher. And again, this is the long-term silver chart. We've looked at this many times, but I want to update it given the price action that we saw today. So long-term cup and handle, very bullish pattern. And if you look at this is the daily chart, we touched right up to this top line of the handle here on this formation today, bounced a little bit off of that. We did come down off the highs of the day, but I mean, we are seriously one trading session away from closing solidly above this line. And if we do get a close around 25.50, 26 bucks, I mean, watch out. Silver has a lot of potential to move in a very significant way. And I do think that if we do get a close above 26, we might retest this line. It'll show that it is now support, and then it'll probably be off to the $29 to $30 range in a very short order. Now, an indication that silver is entering the mainstream. And this is the sort of thing that will really drive the price of silver to new all-time highs, especially the physical market, because the physical market is small. There's not much stuff to go around. And so when you see the price of silver really start to move, it's going to be when your average Joe, your individual on the street who's not a stacker, starts to want to get some of this stuff, right? Something that we haven't seen at all in the precious metals really up until this point. Lots of people out there talking about crypto, lots of people talking about Bitcoin. Very rare you're going to hear people talk about silver, but that's going to change. And this is a story from Business Insider from March 8th. Costco now selling $625 packs of silver coins, as well as their $2,000 gold bars. I'm sure they're pricing those gold bars a little higher than that now. I think to see the prices on their online site, you have to actually have a Costco membership, which I do not have, so I can't share that with you. But very interesting, they're selling Canadian maple leaves, 25 packs. They're calling it packs. I mean, basically, they're selling a tube of maple leaves. They point out in this story, each coin weighs 1 troy ounce and is made of 99.99% pure silver. That's not the sort of the thing you'd really see in a story that was aimed towards stackers, right? Stackers know this sort of thing, but this is aimed at a broader audience, both this story and these coins that Costco is selling. I see a few folks in the chat. I recognize Scott, some other people. Hello, happy Friday to you as well. And hey, do me a favor, if you're watching this live stream, if you're getting some value from this, smash the like button, consider subscribing to the channel. It's very helpful. It helps get this information out into the algorithm. And really, people need to be made aware of what is coming with hard assets, and especially silver, because, in a sea of overvalued assets and asset bubbles, this is something that is still very cheap, but not for long, if you ask me. Now, it's interesting here. They say that they had an earning call in September, and he pointed out that the 20 Galante here, this is, I don't know, somebody who works at Costco. I don't see it in the story here, but they're pointing out that this is responsible for a big surge in their e-commerce numbers that were up 18.4% year over year. It's the gold bars. So silver bars too. Those are or silver coins are likely to sell out, move in a big way. And that's because people is getting put in front of people and they think, let me throw some of these onto my order. I think they had some limits on what they would actually sell. Also, I don't necessarily know I would buy gold or silver from Costco. Interestingly here, this story here points out that the bars have a 4.8 star rating, but the coins, the silver coins, just have a 3.4 star rating. Some people saying that the coins are not packaged properly and that they were scratched as a result. So look, I buy my gold and silver at SD Bullion. If you want a reliable place with a good reputation that's worked in the precious metals industry for a long time, I would check them out. This is the sort of thing, that happens when you end up buying silver from a place like Costco. You might get some scratched coins, and I think they have a no return policy. So that's pretty normal for bullion, but people are reporting that they're problematic. But the important thing here is that this is now becoming mainstream. When you see silver being sold at Costco, when you see essentially a grocery store selling silver coins, that people are beginning to pay attention. But the amount of attention that silver is receiving now is still pales in comparison to what is ahead. Now, I want to change course here a little bit and move on to some of the geopolitical news. We're now going to talk about some of the reasons why silver is, from a fundamental standpoint, likely to move much higher, as well as other hard assets, and in some ways the price of just about everything. A story that we had covered in a recent live stream was that Iran had given the green light to have Hezbollah, the Shiite militias operating out of Lebanon, launch an attack on Israel. Now, that was contingent primarily on Israel launching their invasion of Rafah. Well, now this city at the southern end of the Gaza Strip, now it's being reported here in the Economic Times that Israel prepares to evacuate Rafah as Netanyahu okays a ground operation plan. So this is imminent, this invasion of the southern Gaza city of Rafah. Again, this was the story from the Jerusalem Post from February 28th. about Iran greenlighting an attack by Hezbollah. So that's going to be a much bigger deal than dealing with Hamas. Hezbollah is much better armed. They're geographically more in an advantageous position. They've been launching all of these rockets. Things have been escalating on this border. Well, now you have that catalyst, the invasion of Rafah, which looks like it could set this off. Again, the point here was that Hassan Nasrallah, that is the leader of Hezbollah, he told Khani, this guy who's a Iranian general in charge of the Revolutionary Guards there, that the attack is likely to be very imminent, most likely in the month of Ramadan, which we are now in, or with Israel's invasion of the city of Rafah. So look, you can expect major escalations in the Middle East right around the corner. What will that mean? Well, it could mean increased U.S. military involvement. It certainly is going to mean billions of dollars being funneled into the conflict, more deficit spending, and it also could be very disruptive to global supply chains if Iran gets drawn into this conflict, or if the Yemens in Houthi begin using more advanced armaments, such as the hypersonic missiles, which they now claim to possess. So, this is going to be a catalyst, maybe not, this invasion being launched. It's not necessarily going to drive the price of anything one way or the other, except perhaps the price of crude oil. But ultimately, this kind of instability is the sort of thing which can rock global markets. And, this whole thing is a ticking time bomb. And if you don't think that's the case, just imagine if Iran gets drawn into this, they shut down the Strait of Hormuz, boom, tomorrow you got triple-digit oil, maybe $150, $200 crude oil. That's going to affect everything in a very, very big way. Now, how about this? Some economic data here in the U.S., the ongoing economic collapse, the hollowed-out economy that we are existing in, this debt-addicted financial system, which has now had the screws turned to it by the Federal Reserve as they've hiked up interest rates, supposedly in the name of fighting inflation. We'll talk about inflation in a moment, but let's talk about this. This is the New York Manufacturing Index contracts by more than projected. Imagine that we're losing more manufacturing jobs that actually produce goods and put them into the economy. So the Federal Reserve Bank of New York's General Business Conditions Index decreased 18.5 points in March to minus 20.9. That is a reading below zero on this index, indicates contraction. So we're at negative 20.9. And the measure was weaker than all of the estimates in a Bloomberg survey of economists. Wow, imagine that. Every economist that was polled by Bloomberg got this wrong. And the economy is weaker than they have forecast. Who these economists are, I don't know. But, I expect that in one way or another, they are part of promoting this idea of a healthy, robust U.S. economy. Well, that's just not the fact. We've got this index that has been in contraction territory for 4 straight months. The index of new orders slid to minus 17.2. The measure of shipments dropped to minus 6.9. The index of current employment retreated to minus 7.1. So just about every aspect of the economy in terms of manufacturing, they're laying people off, fewer orders, less business being conducted, they're shipping out less things. So yeah, this is not a good sign. This is another example of why the Federal Reserve, regardless of where inflation is at, is going to have to get out and cut interest rates to stimulate this economy. After all, it is an election year. Part of the reason, a considerable reason why Biden polls so poorly is because of the economy. And it's because Bidenomics is an absolute failure. And shocking that just borrowing vast sums of money and inefficiently allocating it through some state apparatus doesn't give you economic boons. It's not like history hasn't been replete with examples of that. But nonetheless, that's what's going on. So very likely, I think the Federal Reserve, rather than correcting these economic policies, cutting spending, letting the free market do its thing, they're going to try to stimulate their way out of it. How do they do that? Well, they print money, right? They slash interest rates. They monetize debt. Debt, speaking of which, there is just an absolute huge amount of it that they could monetize if they chose to do so, sitting currently at $34.513 trillion, an enormous federal budget deficit, the official number at $1.789 trillion annually. However, of course, we looked at the Treasury financial statement in a recent live stream where if you annualize the deficit from February, it gives you an annual deficit of something like 3.5 trillion. I mean, who knows? All the numbers are cooked, the official numbers. No one is going to tell it to you straight. No one is going to explain to you that the economy is royally screwed, and where we are likely headed is towards a stagflationary recession or depression. And it's a condition in which, well, let's just say having some hard assets like precious metals will probably be very helpful to those of us who have had the foresight to sock them away. You got Janet Yellen here saying she regrets that she said inflation was transitory. Well, duh, but she's kind of doubling down on it here. She says she regrets in 2021 describing inflation as transitory. Yeah, I mean, obviously, because nothing could have been farther from the truth, right? Inflation remains elevated to this day. 3 years later, it's cumulative. Keep that in mind. I mean, it just keeps adding on to itself. The CPI numbers understate everything because you got all this shrinkflation, you've got doctoring of the numbers. They have all sorts of ways that they manipulate the CPI. But yeah, she said it was transitory. She was wrong. Then she's wrong now, of course, saying that we're going to have, a soft landing. She says here that the runway for a soft landing may be a bit bumpy as inflation is proving to be stickier than usual. But Yellen, a former Fed chair, was optimistic about the overall downward trend in price pressures. Oh, imagine that. Well, she was pretty optimistic back in 2021 as well. So, I wouldn't believe her when she says, I wouldn't expect this to be a smooth path month to month, but the trend is clearly favorable. Now, I mean, she knows that the name of the game is debasing the currency. That's what central bankers like to do. That's what the wealthiest members of society who are pulling the strings here benefit from, is debasement of the US dollar. I mean, if you hold all the assets and you're already a multimillionaire or billionaire, increasing the price of food isn't really a problem for you. But, for us average folks, the proletariat down here, we're getting, the value of the currency that we buy everything with. It's just evaporating. So, look, Janet Yellen is also the same person who said that she wouldn't imagine another financial crisis in her lifetime. You know how that played out. So when she tells you that we're headed for a soft landing, you can just expect hard impact falling off of a cliff, basically. What else? We've got some more stories here. We got this from GBI, a Great Britain's news channel. It was hard to find information regarding this, but it was a warning issued by Jamie Dimon in a speech down in Australia. It says recession warning as economic downturn in U.S. is not off the table. According to Jamie Dimon, the CEO of JP Morgan, says the prospect of a recession is not off the table. He also says the Federal Reserve should wait before cutting interest rates. Now, he says that probably because he understands what a significant problem inflation is. If the Fed really wanted to fight inflation, they don't just need to delay hiking rates. They need to delay cutting rates. They need to actually hike them, right? They need to get in there and raise rates higher because they haven't raised them sufficiently to fight the inflation that we have. But they know they can't do that. Their hands are tied because they would collapse the entire financial system. They'd collapse the banking system. They'd bankrupt all of the debtors, which is everybody, the federal government included, along with consumers. I mean, everybody is suffering under these elevated inflation rates. But the one thing that they haven't done is hike them high enough to fight inflation. Says that he says here that the world is pricing in a soft landing, as Janet Yellen says, at probably 70 to 80%. So a 70 to 80% probability of a soft landing. However, then he points out that he thinks the chance of a soft landing in the next year or two is half of that. The worst case would be stagflation. Bingo, Jamie Dimon, that's where we're headed, is stagflation, very likely. The economy continuing to suffer, the economy continuing to be hollowed out, but at the same time, inflation continuing to rise. And that's going to be the difference between this crisis that we're going to face next and the previous ones. Is during the pandemic, during the great financial crisis, inflation was very low. I mean, it was near zero in the great financial crisis. It was like they couldn't get inflation going fast enough. But now inflation is already coming from a very elevated position. And so, if we get a financial crisis, which we're likely to have because of the elevated rates, they're, causing a collapse in the banking sector. They're going to have to cut rates to finance all of the warfare, which we're about to go into. They're not going to be able to pull that same trick off of printing their way out of the crisis because it's going to debase the dollar, but that's likely what will happen. I mean, they're still going to try. here's an example of why the U.S. banking system is in so much trouble. So this is a chart of the Bank Term Funding Program. This is that emergency lending facility, which actually has now come to an end just 4 days ago on March 11th. This stopped issuing new loans. Now, one thing you'll notice is that the last week here, so the most recent data we have, this is should be all in basically because it's from March 13th. The program surged from 164 to 167 billion, so they squeezed out $3 billion of loans there at the end, which was a big move compared to what we had seen in the weeks leading up to that, right? It had been pretty much flat, slightly down. Last week, boom, they kind of use what they can. But the important thing here is now these loans that were issued last March, they have a 1-year term, right? So in 1 year from the date these were issued, these loans mature, and ostensibly the banks should be, I suppose, paying the Federal Reserve back and then getting those treasuries back that they put up for collateral. Of course, a big problem here is that the reason that the banks had to put those up as collateral in the first place was likely to pay depositors. I mean, that was the whole purpose of this, right? The banks had a lot of losses on their balance sheet because of U.S. treasuries that had a low yield. When rates go up, the value of low-yielding treasuries drops. Now, the reason Silicon Valley Bank collapsed was because they had depositors pulling money out. They had to sell some of those treasuries and actually realize the loss to pay their depositors. When shareholders and depositors found out this was the case, they didn't like it, everybody panicked, the bank collapsed. So, enter the Bank Term Funding Program. These small regional banks were putting up these treasuries as collateral to the Fed, getting loans at par value. So the Fed was loaning them the money based on the par value of the loans, not their actual mark-to-market value, which was much lower. So now, I mean, what are these banks going to take back these treasuries and pay the Fed back? How do they even do that if the reason that they needed that cash was to give it to depositors? And this is going to be a big deal because you can see that the utilization of this facility was very significant in the first couple of weeks. So by April 5th of this year, about $79 billion worth of these loans will be coming due. And what are the banks going to do? I mean, where are they going to get the liquidity to get these loans back and then take these treasuries back onto their balance sheet? Well, it could be a recipe for a really big problem. So keep an eye out in the next couple of weeks. I would say that, heading into June, even this could be a problem. That's kind of when this flattened out. But by June 21st of this year, there's going to be $102 billion worth of these loans coming due for these banks. So you can see why this is a big problem. And it's very likely the Fed is going to have to get in and, bail these banks out some other way. I mean, what are they going to do? I don't know. I mean, maybe they will slash rates or initiate QE to drive down the yield on treasuries. That would mean that the treasuries on the bank's balance sheets could regain some of their value, right? If interest rates came down. Alternatively, we may see more, QE by any other name, which is basically what this program is. But this is just another indication of why we are likely to get that stagflation, because the Fed is going to have to cut rates. When they do, silver is going to be moving in a very big way. And, when it becomes clear to investors how bad this house of cards situation is and the fact that stagflation is coming, you can expect all the silver coins at Costco to sell out, all the silver coins at your online dealers to sell out. You can expect local coin shops' inventories to be drawn down as it becomes clear what is going on here. And look, I'm not telling anybody what to do. I'm just telling you my thoughts on things. I am continuing to allocate some capital towards physical metals on a regular basis, just dollar cost averaging. I do think that silver is still incredibly undervalued. It's on the verge of a possible major technical breakout. We're going to have to wait and see what happens with that, but it's getting very close. I mean, we could literally be days away. If you look at the chart, I mean, it really says everything. You see how close we are to this trend line here at the top. And if we blow through that, I think it's going to be off to the races. But anyway, let me know what you think about all of these developments in the comments down below. Thanks for watching, everybody. Don't forget to smash that like button, share the video with your friends, and I will catch you next time. Stay safe and happy stacking, everybody. Smart Silver